You don't even have to say it. I already know what your question is. What's your rate? What's my rate? What are rates? What's today's rate? What's tomorrow's rate? What's yesterday's rate? You want to know what the rate is. In today's video, I'm going to show you why there is no one rate, how to look at a rate sheet, and how this all works. We're going to do a little behind the scenes with mortgage rates today. All right, Matt, the mortgage guy, residential mortgage broker, powered by You Mortgage, licensed across this country in 46 states. Me and my team are happy to help you. If you want to get yourself pre-approved or you want to connect with me and my team, go to greatmortgagebroker.com. The most common question, what is the rate? What is my rate? In today's video, I want to show you exactly what I'm looking at as a mortgage broker, show you a little bit about behind the scenes. So hopefully you understand a little bit better how mortgage interest rates work and why there's not just one rate, why it's a little bit more complex on just what's my rate, right? There's a whole rate sheet, rate stack, whatever you want to call it. The good news is, as I was doing some research for this video, I looked at old walkthroughs of rate sheets, and it literally used to be a sheet, right? It used to be paper where you'd have to, find this grid, make adjustments if it was above 80% loan to value, if your credit score was between 700 and 719, you had to manually calculate all this stuff. Nowadays, you don't. So what you do when you're getting a mortgage or you're talking to a mortgage broker who's shopping for a mortgage for you is you put in all the criteria. What's the use? Is it a primary residence? Is it investment property? What's your credit score? If you've got credit pulled in the system, it's there. If you're just doing a pricing scenario, you can guess or put in a value, right? So credit score is 777. What's the purchase price? What's the down payment? Then you can price it and you can see what the pricing looks like, in my case as a broker, at multiple different lenders. But it doesn't stop there. Not only do you have multiple different lenders, you've got a rate sheet for each individual lender. This is exactly what it's going to look like on my side. Pricing, I think this was a $650,000 purchase with 25% down. So 487 loan amount, 75 LTV, great credit. As you can see, I've got different lenders here that I can look at. And the point I was making earlier, let's look at this first lender. We've got 5.99%. This negative means it's a credit back to you as a consumer of $166. As the rates get better and you go up this sliding scale to 5.75, 5.5, 5.25, up by eighths, the numbers get larger and larger. And this down the middle is discount points, meaning the cost for that interest rate. I'll stop and I'll highlight 5.625, 1.018%. Means it's 1.018 points or 1.018% of that $487,000 loan amount or $4,900. It does the math for you in order to buy the interest rate down to 5.625. Now, here's where you start to do some math and you talk to a professional who can analyze this stuff for you. If I can get you a 5.99 with no points, this is the principal and interest, $2,922 per month. You can look at that and say, well, if I spent $5,000 to lower it to 5.625, I've got a $2,806 principal and interest payment. That's a $106 difference. And quick math, without even having to break out the calculator, saving about $100 a month, spending about $5,000 to do it would say 50-month break even, probably closer to 48, which is exactly 4 years. So 4-year break even. Am I going to stay in this loan for more than 4 years? If I think I am, and I'm pretty sure about it, maybe you buy the interest rate down. If you're not, maybe you take the interest rate that doesn't cost you anything. This is all analysis that's based on you and your personal situation, what you are doing, how long you expect to stay in the house, and all those things. So, important things to think about, so you can go up here and get a point in credit if you want to take 6.875 and then get 4,800 in credit from the lender. Might not necessarily make a lot of sense to put yourself in this higher payment unless it's something that you're going to be out of there in 18 months or something to that effect. I want to pull up another lender's rate sheet just because I think it's good to give these other lenders some love. Some of my favorites: Windsor, EPM, UWM, all favorites. But it's important to look up and down the rate sheet. Every single eighth is going to price different, right? Go from 6.375 to 6.25, and it cost you 1/5 of a point, 0.207, known as 20.7 bips in mortgage speak. That cost $1,000. You get to go to the next 6.125 for only $150 more. Sweet. You would never lock at 6.25. You would always do the lower rate, save you $40 a month when it's only $150 in cost. But then you see how the next eighth from 6.125 to 6% costs $2,000. So you probably don't want to do that. That's a 50-month break even. So maybe, but look how close these two are. These two are close. So if you're going to go down, that's because it's 599. But even 5.875 is close. If you're going to, the sweet spots are here at 6.125 or here at 5.875. Let's go back to UWM where I've got the best pricing. 599 costs you nothing. It costs you a point to get to 5.625. But look at that spread there between 5.75 and 5.6. It's only 4 basis points. Literally, $200. You wouldn't do that. Wouldn't want to take that. So this is how it works. And everybody's scenario is going to be different. You want to be working with somebody who can kind of walk you through and talk you through some of this stuff. What are your goals? How long do you plan on staying in this house? Do you have credit from the list side? And maybe you have some money to spend on points. Maybe you're conserving your capital and your money, and you don't. You've got a reason to believe you're going to refinance this in the fairly near future, or you've got reason to believe that you might be selling this home 2 years from now, and so you're not going to put a lot of money in up front to buy the interest rate down. So that was a quick little tutorial on rate sheets, what they look like, how they work. In the volatile market we're in 2023, these rate sheets are acting a little funky. This specific scenario didn't have it, but on some of my government stuff, on my FHA or my VA loans, I might have a lower rate that actually cost less than the higher rate. Generally speaking, you go up the rate sheet, lower in rate, you're paying less per month, but you're paying more up front. In some of these cases, I might go from 5.75 down to 5.5, and the 5.5 is cheaper. It's, more than we need to talk about on this video, why on the back end they're trying to steer you towards a certain rate. But if they're going to give you a cheaper rate at a lower price, you're always going to take it. Hopefully this was helpful. Let me know what else you want to see. I'm happy to do any behind the scenes stuff. I was talking to my team today, and generally speaking, we're always transparent about everything we do. Nothing's a secret. There's no, stuff we need to keep from the consumer so that we can, strategize about sales. We're just giving it all to you and helping you make the best financial decisions possible, creating life-changing opportunities through homeownership. Thanks for watching. Let me know what you think. Check out the other 850 some odd videos I got here, and here. They're all over the place on different stuff.